NIO stock had one of its wildest sessions in recent months on Thursday. The stock opened sharply lower, plunging by almost 10% in early trading, before clawing its way back to finish the day slightly higher, up by just 1 cent, or 0.15%, at $6.83 per share. The volatility was driven by breaking news of a lawsuit filed against the company by one of its largest and most respected institutional investors, Singapore's sovereign wealth fund, GIC. The court case has added a fresh layer of uncertainty for investors and reignited debate around NIO's accounting practices, transparency, and long-term credibility. According to reports, GIC has filed a suit in the United States accusing NIO and several of its executives of misleading investors and inflating revenue figures through related party transactions. The lawsuit claims that NIO used a battery asset management company called Weineng to artificially boost its reported sales and financial performance. If that name sounds familiar, it's because the same allegations were first raised back in 2022 by short seller Grizzly Research. NIO responded at the time by conducting an internal review and said that the claims were unfounded. But what makes this development more serious is that it's no longer a small research firm making the accusations. It's now coming from one of the most credible investors in the world, a sovereign wealth fund with hundreds of billions of dollars under management. The suit names NIO, its chief executive officer, and other senior executives. It alleges that the company failed to properly disclose the nature of certain transactions and that those omissions misled investors about the true strength of NIO's revenue. NIO has rejected the claims and stated that it intends to defend itself vigorously. The company maintains that its accounting practices comply with international standards and that previous audits found no wrongdoing. When markets opened on Thursday morning, the reaction was swift and brutal. The stock collapsed nearly 10% within minutes, as traders rushed to price in potential legal risk, reputational damage, and the possibility of prolonged uncertainty. Heavy volume accompanied the drop, suggesting that both institutional and retail investors were caught off guard. But as the session went on, something unexpected happened. NIO began to recover. By midday, the stock had regained more than half of its losses. By the closing bell, it was back in positive territory. The sharp reversal revealed a fascinating dynamic between fear and conviction among investors. Part of the rebound was likely driven by traders who viewed the early sell-off as an overreaction. Once the initial panic subsided, bargain hunters stepped in, seeing value in the stock's rapid decline. There was also likely a wave of short covering, traders who had bet against the stock closing their positions as the downward momentum faded. Together, those forces helped the stock rebound and end the day nearly flat. This kind of intraday recovery suggests that investors are still willing to give NIO the benefit of the doubt, at least for now. It also shows how quickly sentiment can shift in a name that already trades with high volatility. While the lawsuit was the main story of the day, it landed against a broader backdrop of nervous markets. Tensions between the United States and China remain elevated, and investor trust in Chinese equities is already fragile. Over the past few weeks, renewed rhetoric around tariffs, export restrictions, and economic nationalism has made traders more cautious toward Chinese-listed companies. In that environment, any negative headline, even one unrelated to trade, tends to hit harder. So while Thursday's volatility was primarily driven by the lawsuit, it was amplified by the macro mood. Investors are on edge. They are not just reacting to NIO's specific situation but to the larger question of whether Chinese companies can be trusted to operate transparently in global markets. The legal allegations against NIO feed directly into that anxiety. From a technical standpoint, the price action on Thursday was significant. The stock opened with a massive gap lower but quickly found support near the $6 level before staging a strong recovery throughout the day. On the chart, that created a long lower wick, a pattern that often signals buying strength and a potential short-term bottom. It suggests that there is still demand for NIO shares when prices fall too far, too fast. However, whether this marks a sustainable base or just a temporary bounce remains to be seen. For long-term investors, the key issue now is how NIO manages the legal process. Even if the company ultimately prevails, the existence of the lawsuit itself creates a new layer of uncertainty. Legal cases like this can take years to resolve, and in the meantime, they can weigh on valuations. Investors will want to see clear, transparent communication from NIO, possibly even a new independent review to confirm that its financial statements are accurate. Rebuilding confidence will take time. The fact that the lawsuit revives old accusations that investors had mostly moved past is especially damaging to sentiment. It reopens a conversation that many hoped was closed. But it's worth noting that these claims are not new. They have been investigated before, and NIO continues to insist that there was no wrongdoing. The question now is whether the market believes that story. Looking at the bigger picture, NIO's underlying business fundamentals have not changed overnight. Vehicle deliveries remain solid, infrastructure expansion continues, and the company's position within China's premium electric vehicle market remains strong. The lawsuit doesn't change those operational realities, but it does affect how investors price the risk around them. In other words, NIO's business might still be performing well, but its valuation could remain under pressure until this legal issue is clarified. There's also the question of how this fits into the current geopolitical environment. Even though Thursday's events weren't directly linked to trade policy, they contribute to the same theme of skepticism that has haunted Chinese stocks all year. Western investors are already nervous about the opacity of Chinese regulations, potential government interference, and the reliability of financial disclosures. This lawsuit reinforces that narrative and could deter some institutional capital from returning to the space until trust is restored. That's why Thursday's price movement matters. It wasn't just a legal shock. It was a test of market psychology. The stock's ability to rebound so strongly after a 10% collapse shows that there is still a core of investors who believe in the company's long-term potential. But it also highlights how quickly confidence can be shaken when corporate governance concerns resurface. In practical terms, there are now three likely paths forward for NIO stock. The first is stabilization, the idea that after this initial shock, the market digests the news, the company defends itself, and prices gradually find equilibrium between 650 and 720. The second is renewed downside, where additional revelations or regulatory involvement could drive another wave of selling. And the third is relief, if NIO releases a strong defense or positive operational updates that reassure investors. For now, the most probable scenario is stabilization with caution. Investors appear to be balancing their skepticism with curiosity, waiting to see how NIO handles the lawsuit before making any major moves. The next few weeks will be critical, especially as new filings emerge and management responds publicly. Thursday's session was more than just a volatile trading day. It was a snapshot of how fragile confidence can be in a high-profile growth stock. The company didn't lose billions in market value because of poor performance. It lost trust temporarily because of perception. Trust can be rebuilt, but it takes time and transparency. NIO's leadership now faces a moment of truth. They will need to address these claims openly, reassure shareholders, and demonstrate that the business remains solid beneath the legal noise. Investors are not necessarily expecting perfection, they're expecting honesty and clarity. How the company responds over the coming days could determine whether this event becomes a short-lived scare or a long-term overhang. So what should investors take away from Thursday's chaos? First, volatility often reveals where the real conviction lies. The fact that the stock bounced back so sharply suggests that some investors still see long-term value. Second, the legal risk is real, but it's not new. The market's overreaction at the open shows how quickly fear can outweigh facts. And third, while the fundamentals remain intact, sentiment will drive the near-term outlook. Until the lawsuit is addressed, uncertainty will cap the upside. In the end, Thursday's 1-cent gain doesn't tell the story. What tells the story is how the stock went from panic to recovery in a single day. It was a reminder that markets are driven as much by emotion as by logic. NIO's journey today was a microcosm of that truth, a plunge fueled by fear, a rebound powered by resilience, and a close that leaves more questions than answers. The coming weeks will determine whether today's rebound was the start of stabilization or just a pause before the next move. For now, the company's credibility is under the microscope again, and investors will be watching every statement, every filing, and every headline with fresh intensity. And that's your NIO Thursday Aftermarket update.